post the link. So I've been streaming my afternoon meetings on YouTube recently. People tell me that the video quality is better through YouTube than it is through the VTF. So Robert just posted the link here, so you guys may want to watch it through the YouTube. But any questions that you have, it's easier. I don't read the questions off YouTube, though people tend to copy and paste them into the VTF for me. Any specific questions that you have today during the afternoon meeting or in the Q&A portion are definitely going to be better off directed into the virtual trading floor itself. Still waiting on the VTF screen share to load. For some reason that's acting slow now. But while I wait for that, since we're up on YouTube, I will start with the required compliance disclosure that I am an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. All trades placed by me are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There's the position disclosure. And let's bring up some charts. And finally, the VTF screen share is working. Yeah, for sure, Brian. For sure, Brian. Looks like Vail Resorts, MTN, just had a solid miss on their earnings. They're down, I don't know, 5% as of last print or so. Very thin trading. So many ski resorts. My local mountain was always Hunter Mountain in New York, and they were owned by two brothers forever, and they were great at snow blowing and did the best for an upstate New York mountain. And Vail came in and bought them a couple years ago, and it's just been absolutely terrible there. And I am an Epic Pass buyer every year for a long time, and I am seriously considering not purchasing my Epic Pass for next season. K27, sick run. Absolutely. Lower K there is no joke. If you can, what's that line? You guys ever seen, what the heck's that guy? Johnny Drama from, can't remember the name of the show. You can ski Hunter Mountain, you can ski anywhere. Yeah, Entourage. There you go. He goes, you can ski Hunter Mountain, you can ski anywhere. It was like the best line ever when they go out west that time to kind of do some skiing. I would consider the Icon Pass, but when I'm back in New York, if anybody's got the YouTube link, if you can post that, it'd be appreciated. Yeah, I don't even remember what I was going to say. Yeah, when I'm back in, the problem when I'm back in New York is that there's no mountains that are nearby on the Icon Pass. Otherwise, I would consider it. Icon's got a couple mountains that I really love. I love Copper Mountain there in Colorado, if you've ever been. But I think I'm just going to have my mountain collective, and that's it for next year. I'm considering dropping Epic Pass because Vail Resorts has just been doing such a terrible job, and they treat their employees very poorly also, which I don't love. I don't love it. All right, let's get into the meat of the meeting today. Let's talk about this abomination of a stock market we are in. Looks like we just bounced the dollar since the market closed, which is interesting. But as of right now, we're down 0.5% on the day for the SPYs, which isn't too bad. And keep in mind that's including this dollar bounce that we just had. Chemo's on Epic Pass, Killington's Icon. Qs are down 1.6%. Qs are up, that's including the $1.50 bounce here that we just had. It's a big bounce in the Qs. I don't know if any new news just came out since the market closed. And now the IWM is only down 1.8% because they have also staged about a $1.50 bounce back since the market closed. So interesting. I'm not seeing any headlines here in the VTF in this moment that we can attribute this post-market bounce to that just happened in the last 15 minutes. But notable. All right, so markets today, obviously super weak, super bearish, downside continuation. And this is what we spoke about and kind of prepared for in the morning meeting today. Let's recap it. So let's start with a 5-minute chart here of the market. We ended up having a very small common gap up in the SPYs and the IWM, and a common gap down in the Qs, which were relatively weak pre-market. And then we saw pretty quickly when the market opened that the Qs actually took a foothold of some relative strength. Coop just reported earnings, scroll up, that the Qs showed some intraday relative strength, while the IWM immediately became what was leading us lower. And the SPYs, which include, sectors like the XLF, which was, really relatively strong today, the SPYs were able to hold at best, being only down a half a percentage point. And this, by the way, the consistent money rotation that we've seen so far in this bear market, that there always seems to be some sector catching a bid. That's why you see the Russell in bear market territory. That's why you see the NASDAQ in bear market territory, but the S&P a little bit better. The S&P is only in correction territory. So, really early pre-market this morning, it looked like we were going to have a pretty big common gap higher in a bear market across the board. But a whole bunch of headlines came out. There was a whole bunch of pre-market volatility. And by the time we opened up kind of more flattish. And what I spoke about in the morning meeting today is we have every reason to go down today. We had every reason to go lower. So it would have been really interesting if we didn't. It would have really showed us something. But there was every reason to go lower. Technically, fundamentally. So from the technical picture, we are in a bear market. Okay, even the S&P, which is technically not an official bear market, is not down more than 20%. It's a bearish market. It's a downtrending market. We are trending down on every time frame for the most part. The only thing maybe we're not trending down in is if you want to scroll out on like a really, really big picture. But for the most part, I mean, just look at this here. This is a really bad price action. It's a very clear short-term, intermediate term, and honestly at this point even long-term downtrending market. So we have downtrend time frame continuity is what that's called. So very simply put, you're in a downtrending market, you're going to broadly be better off being short than long. And then we want to add our gap analysis on it to have a better understanding of opening execution. At one point this morning we were set for a common gap higher, which also would be a thing that you would technically want to short. But by the time we opened, it was a flattish open. I hate flat opens, by the way. Flat opens are really difficult to trade because you don't have the advantage that the gap actually provides you as far as information goes. And gap analysis is definitely a big part of kind of my opening research process when I'm figuring out, more of a big picture game plan. So that kind of sets the stage for us technically. Fundamentally, and I was saying this early on, the reason why we were initially looking to gap up this morning is because oil was down. So, oil was set for, USO here set for a 5% gap down. And generally what we've been seeing is that oil and the market have been trading inverse to each other. So, oil being really strong, that tends to mean heightened worries out of, at least recently, it tended to mean heightened worries out of Russia and Ukraine. So oil really strong, market down. But whenever the oil market's kind of taken a rest or had a pullback or whatever, then the equity market would start acting a little bit stronger. So, this morning there was some chatter, and again, it's chatter that I don't think anyone can believe in at this point because we've heard so many mixed things, sometimes on an hour-to-hour basis. But coming into this morning, there was chatter about an improving situation between Russia and Ukraine, that maybe they're going to be more open to certain degrees of talks or whatever. But that was kind of being confirmed by the oil market, having a pretty significant gap lower. And XLE, set for its kind of first down day in a while, in a lot of ways. XLE closed the day down 3%. So it kind of sets the stage, and you'd be thinking maybe up. But those headlines that came out of China, I think we were able to recognize pre-market were really bad. So, because China is dealing with a new surge of COVID, I'm going to go ahead and still assume, I know someone here in the VTF said that it wasn't, but I'm actually, until I see real official data, I'm going to assume that surge in COVID is the Omicron variant, which isn't as concerning, but it's still equally concerning if it just means that China's going to shut down. because China, as we know, has been implementing what they call a COVID zero policy. So that basically means that if 5 people test positive in a city of 9 million, that the entire city is being shut down. And we actually saw that, I think, on Friday. We saw one city, and I'm not sure which city it was, but we did see there was 9 million residents. They basically shut down the entire city because there was an outbreak of COVID. And what do we know about Omicron? We know that Omicron has generally been a less severe version of COVID, but much, much more virulent, much more contagious. So easily spread. So I guess over the weekend and into today, it's spread into Shenzhen, Shanghai, which, you know, that's like 2 of the most major cities, obviously, in China. Seeing some information here from Geoff. The China surge is Omicron. However, there's a new variant in Hong Kong that looks like a cross between Omicron and Delta. Great. So anyway, the repercussions of a surge of COVID in China, along with China's policy towards COVID, basically means that they just shut down, you know? So we saw this morning that one of the Foxconn factories, and I think I saw someone say that they produced 500,000 iPhones there or something. Someone said that in the VTF at one point today. Also is getting shut down. And the reason why this is so bad is because of supply chain issues. So we all know there's a lot of trade between China and the United States, and one of the major contributors prior to the commodities situation we've seen recently, basically the major contributor that's been out there of inflation has been supply chain issues, right? Just difficulty producing goods and also difficulty transporting those goods to the United States. So if all of a sudden the factories in China are going back into lockdown mode, well, that just exacerbates the problem of supply chain issues. And I actually have been an inflation bear on the supply chain issue situation. I've been saying for a while, like, yeah, I'm not going to use the word transitory when it comes to inflation, but I really think, you know, there was a big conversation for many years about how all of the money pumping that the Fed did into the financial crisis did not create inflation. And the other side is that there have been other things going on that kept inflation down. So globalization, and you can make your arguments about it being a good thing or a bad thing, but it's an objective fact that globalization lowers costs and reduces inflation. So global trade. We have seen increase in global trade over the course of the last 10 years. It's helped to damper down inflation. Technology. Honestly, companies like Amazon. You know, the fact that you can get goods cheaper and cheaper and cheaper, that you can get, you know, televisions and technology type things cheaper over time as the technology improves, that type of stuff always worked to damper inflation. So I looked at the supply chain issue like this. Sure, it's a huge issue. We shut down the entire global economy. It's going to take a lot of time to potentially come back from that. And at the same time, there is an extraordinary demand from Americans here who all of a sudden have a lot of money and they want to spend, which is not bad for the economy, but it's not good for inflation when you've got supply chain issues. But I'm a believer in the capital markets. So if there is demand for goods and that demand is not being satisfied and people are willing to pay up for it, guess what? People are going to get them their goods. You know, it's going to happen. And if anything, I almost felt for a little bit we had to be worried about kind of overdoing it, where, you know, we ramp up production so much on certain stuff that once we get through the, you know, the extra demand that's coming out of COVID from typical people, that it would start to bring inflation down. And again, that's really food and energy. I think the food and energy situation is an entirely different situation, and there's a supply and demand problem when it comes to energy right now, globally and here in the United States. So that's kind of what I thought was going to happen. But now if all of a sudden this news is coming out this morning, that turns my thesis upside down. Continued supply chain issues when we're already having this inflation problem could cause inflation to stay. And the problem with inflation staying, and this is what we saw in the 1970s, is once the markets start to price in inflation, once the companies that are out there start to assume inflation in their business model, it becomes like a self-fulfilling prophecy, and it becomes really difficult to get rid of. And that's when you saw, Paul Volcker, famously in the, I think it was like 1980 or 81 or something, come in and hike interest rates up massively in order to create an artificial recession in the United States to tamper down inflation, which I think was a tremendously brave act by that person to do that. And maybe created some short-term suffering, but created long-term prosperity. So that was kind of my initial thought process on it. And then again, I'm coming in today, and I'm like, all right, oil's down, market's gapping up. Like, yeah, you know what, the technicals are bearish, but maybe we could begin to stage one of these bear market rallies off this kind of setup here from the big picture macro environment. And then I start seeing the headlines about the China supply chain issues because of COVID, and I'm like, forget it. This market can't catch a break. We go from a weak market because of inflation and interest rate increases to exacerbating that because of the Russia-Ukraine situation and then what commodities begin to do. And then just, each time it looks like you're starting to price something into the marketplace, the next hammer drops, and now all of a sudden it's, China supply chain issues again because they're shutting down factories because of COVID. So what ended up happening for the market as a result is just, tremendous weakness once again, which coincides with the technicals. And like I was saying in the morning meeting today, we were not very extended this morning, especially when we were gapping up. We're not extended at all. So for people who are new to the team here, the way that I measure extension in the marketplace is where the market is trading versus the space between the 8 and 21 EMA. So the space between the 8 and 21 EMA. So in a downtrending market, the 8 EMA is going to be what I call the lower band of equilibrium. That's my line in blue here on the chart. The 21 EMA is the red line on my chart. That is going to be what I consider to be the upper band of equilibrium. In an uptrend, it becomes the opposite. So when you're in a downtrending market, that market's going to have degrees of ebbing and flowing. It's going to have degrees of extension and satisfying that extension. And when the market becomes really extended away from equilibrium, it becomes much more difficult for that market to go lower, and therefore your risk reward and probability of success of shorting in this case becomes much worse. Whereas if you are in or at equilibrium or touching that 8 EMA or whatever it is, then and it's a bear market, it's trending lower, you're going to have a much better risk reward and a higher probability of success on those short trades. The biggest bounces that we've had over the course of our bear market have occurred on January 24th and February 24th. And by the way, to give the team here in ProDesk VTF a pat on the back, we called those bottoms perfectly here, both of those days. And we really caught the upside on that as a team, particularly the second one. We were buying right when the market opened on that day. It was phenomenal. But part of the way we were able to catch those lows was just by understanding extension. Like the degree of extension, especially on this January 24th low at lows, was just massive. So, on this day you had the SPYs trading at a low of 420.76 with the 8 EMA at 451. So you had the market for the SPY, the S&P here, was extended to the downside at lows by $30 in a $400 ETF. And then this time here, that's a lot for the SPYs. I feel like that's one of the biggest I've ever seen. And then here on February 24th, you had your SPYs trading a low, basically, which is where it opened, at 410.64 with the 8 EMA at 433. So here you had it extended by like $23 to the downside, also massively extended. But this morning, we weren't extended at all. And the market closed at lows on Friday, which is bearish. We are below all levels of support. We are downtrending on every time frame. Market looks technically terrible coming into today. And even as of today's close, which is about 417, and now we're trading up a little bit. So even right now, we're at 417.66. 21 EMA is at 423.65. We're extended by $6 to the downside in the SPYs. we might be approaching a degree of extension here with the market where it doesn't pay to continue to whack to the short side. Even if we gap down tomorrow, if we gap down a couple bucks tomorrow, if we gap down to 414 or something like that, I'll be telling everybody tomorrow morning that the market's too extended to short here. You want to already have those shorts on and just be reaping the reward of it. But this morning, and kind of even at this closing price, this morning we weren't extended to the downside at all, and now we're extended by $6. $6 of extension to the downside from the ADMA is notable, but it's not $30, it's not $23 like we saw in January and February. So this market, even as it's becoming a little bit extended to the downside here, can easily become more extended. And this is also where we want to pay attention to a lot of the stuff that Pat gets into his morning note every day. We want to be paying attention to positioning, sentiment, things of that nature. I'm going to go ahead and assume ahead of time here that we'll see tomorrow morning, maybe Pat has it now, that short-term sentiment indicator, which is one layer of probability that I like to look at for the market, is probably going to be a little bit cooked to the downside and be in the buy zone, which again doesn't mean buy to me. It just really means don't short. So we can assess all that tomorrow. But once again, broadly, this market for the S&P is very bearish. Let's take a look at the Qs, see if we have confirmation. NASDAQ looks like a new yearly low, super bearish. Qs are trading at 318 or so with the ADMA at 329. So Qs are a little bit more extended to the downside than the SPYs, which makes sense because they're higher beta, and the yellow is the 200-day. They're higher beta, and they've been relatively weak. So the Qs are extended by $11. It's also a cheaper ETF. So it's a notable degree of extension here, but it's also not so extended that we can't continue lower. It just will probably mean like if we gap down tomorrow, that's a little bit too extended to actually come in and short. And then finally is the IWM. And the IWM has been really interesting because it led the market lower starting in November, but for the last month and a half, it's actually been broadly relatively strong to the other indices until really Friday and today. All of a sudden, the IWM, it seems like it showed renewed relative weakness today. So, like if you go back, pre-market today, the Qs were relatively weak. They were opening red. The IWM was relatively strong. It was opening green. That switched right away. The IWM was the sector that was leading us lower today, and every time the market bounced, it was the Qs that were actually leading us up. And again, why am I going over all this information? Just to take a half step back for the people who are new on the team here. The market is your ultimate layer of probability. I think everyone in the VTF heard me say multiple times today, it doesn't matter how strong your stock is. Like Facebook was showing great strength today. It was green. It was trading really well off the open. If the whole market gets annihilated, it doesn't matter how strong your stock is. It's eventually going to end up rolling over and being weak also. The relative strength and relative weakness at the same time, this is why I'm talking about this juxtaposition between Qs and IWM, what's stronger, what's weaker, is also a really important layer of probability. Because if you do think that the market is going to bounce, then you want to go towards what is relatively strong. So in this case, like we saw, like if you wanted to buy a tech stock today, intraday, we saw Facebook as being a leading stock, which is also interesting because it's been relatively weak on the daily chart. So you also have to pay attention to relative strength and relative weakness on kind of multiple time frames. So anyway, you can see really early here that the Qs took over strength from the IWM. Look at 940. Look at this candle here at 940. Qs were a little bit sloppy for the first two candles and then caught a really big bid all the way to the space in between the 8 and 21 EMA, again, that equilibrium zone for a 5-minute chart. Whereas the IWM here just opened up and just immediately down, and that bounce was barely able to tick the 8 EMA. So you could kind of see the intraday relative weakness. You could see that the IWM was leading us lower pretty much right away, which I viewed as not a great sign. So that's kind of our market. And at one point today, short time frame, interestingly enough, we're acting well. And this is why, again, the way that I like to approach the market is to recognize that every possible scenario has a degree of probability to it, right? There are just higher and lower degrees of probability. And what influences that is what we on the team here call layers of probability, which is all of the different factors that can influence a stock or can influence a market at any given point in time. So we knew or felt in the morning meeting that big picture of this market had every reason to go down, fundamentally and technically. but yet pre-market it was able to be strong. We do have USO, kind of trading negative, and look at how strong the market was this morning. I also always want to pay attention to key levels on multiple time frames, because if the market can get above or is holding below certain key levels, it provides you other information on probability. It provides you other information on whether you are better off being long or better off being short or kind of whatever. So we know that we are below all the key levels in the big picture, which is telling us that we'd rather be short. But in the small picture, I identified some key levels where if the market could get above, then things will be looking a lot better, and maybe we can start looking for some longs. And it would be worth noting that if with all of this bad news and bad technicals, if the market didn't break down today, that would actually be a bullish signal. I think I also said in the morning meeting, and I've seen this happen many times over the course of my career, when bad news comes out and the market doesn't go down, or your stock doesn't go down after it's been going down for a while, that's very notable that a bottom actually might be coming in. And the opposite is true also. When the market's been trading really well and everything is up a lot and really good news comes out and the market can't continue higher on that really good news, it means that there's no buyers left. And it's notable because you could be looking at some sort of shorter term top. One example that we noted a while ago actually was the last Robinhood earnings here. This Robinhood earnings on January 28th, I think it was January 28th, was like one of the worst earnings reports I feel like I've ever seen. And it went green that day. And it's still basically the all-time low for Robinhood. That's just kind of a case in point. So if with all the bad news today, if the market didn't break down like it should, that would be notable. And again, even though everything says we should be going down today, I still need to keep in my mind that there's a probability that we don't. And the technicals will confirm that on smaller time frames first. And the SPYs actually were able to do that. So the spot I was talking about off the open this morning was 422 in the SPYs. This opening high, right? Opening high, IWM leads us lower, SPYs drift lower, Qs drift lower. We get this important pivot point here at 940. This is a really important candle. I did note that it wasn't on spectacular volume, but it was a strong Maribozu candle that very short term, noted some strength here from the bulls. And then we broke up. 422 is the key level. At 10:05 a.m. on a small time frame, in the S&P specifically, the bulls are in control. And that might tell you, actually, to start looking for some long trades. The problem was, and this goes back to probability, if the S&P is telling me that the market in a small time frame is looking bullish, but the NASDAQ and the Russell are not confirming it, does that mean that my longs are going to have a higher probability of success or lower probability of success than if I can get the NASDAQ and the Russell to confirm it as well? It means that they're going to have a lower probability of success. So if I go over to the NASDAQ, the level I was talking about in the NASDAQ that we needed to be able to recapture was 326. So we can start getting a close above 326, which is basically this line here, that the NASDAQ would be proving itself. And we actually did tick above it here a few times. I think one of these bars even closes above it. But we never really got that full confirmation from the Qs, and then they broke down. And once this candle happened here at 10:30, and we broke down, I was like, you know what, this is going to be very hard for this market to go higher despite what the SPYs are doing. And the IWM basically needed to make highs in the day, and it never even got close to trying. So whereas the SPYs here at 10 a.m. are telling us we can look for longs, the fact that we don't have confirmation from the NASDAQ and the IWM means that those longs are going to have a lower probability of success. Which doesn't mean don't take them, it just means be careful. And when you're looking at individual stocks to potentially buy, what do you want to pay attention to? Again, you want to pay attention to what's strongest. So, one trade that I called out was Facebook. Facebook off the 10 a.m. pivot low. I basically called this out like as it was breaking back through 189 as a buy versus this low. Small risk. It's a very small risk trade for Facebook. So small risk tends to mean worse probability, but better risk reward. And that gave great initial follow through. And then of course the weakness in the market eventually got to it and it failed. But if you've got good game planning, which is what I'm going to be talking about tomorrow, there should be no way that anybody lost money on this Facebook long. It worked. It just didn't work extremely well. It worked more than enough to cover your risk and to make money on it, depending on the specifics of your game plan, and was not a losing trade. So that was the one that I called out. Someone else called out Tesla. Tesla similar here. Early was showing relative strength, kind of gave that higher low. So that was also a decent looking one as far as tech goes. Just again for smaller time frame executions on trades as the SPY is looking better. So that I guess goes to show the importance of relative strength and relative weakness, but also goes to show the importance of the layer of probability, which is the market, because we never got the confirmation from the Russell and the Nasdaq. Eventually, the market failed, and when I first was having to step off the radio, which was going into 11 a.m., it was actually when the market was making highs. I said, all right, small time frame here for the S&P is looking great. We're not getting confirmation from the Nasdaq. We're not getting confirmation from the Russell. Just know your key downside levels, because we still are in a bigger picture bearish market, and if we start to lose our key levels, then you got to get yourself stopped out, get yourself out of the way, and possibly get yourself short. So what are our key levels? I said the 10 a.m. low specifically, and the low of the day. You start losing the 10 a.m. low and you start losing the low of the day, then the market's telling you it's shot. And sure, if your longs are holding up because they're really relatively strong, then stick with them, of course. Buy the ticket, take the ride. Like I said when I answered someone's question earlier today, buy the ticket, take the ride is a thing that I believe in. But for the most part, the market's showing you that it's failing. And at the very least, even if you're not stopped out of your current positions, and of course you always want to be managing your risk, you want to make sure you're not fighting this market at this point. You can't be buying new positions when the market's breaking key downside levels, when everything's looking bearish. We can't be buying things on the way down. We have to be buying things on the way up. So once the markets started to break their key technical levels on the downside, we flipped the switch. And that was pretty much it. Post 10:30 a.m., the 15-minute chart does become more important. I think this 15-minute bear flag was communicated. This would have been a great opportunity now to try to put on shorts. Then we also spoke about, a possible short here off of this 15-minute inside 15. First of all, actually, we nailed the bottom on a buying opportunity here. And the way that we nailed that bottom was we saw the volume pick up. We saw the market getting extended on multiple time frames. Again, that same concept of extension that I was just talking about for daily charts applies on every chart. Applies on 5-minute charts, it applies on 15-minute charts. And understanding your time of day and degrees of extension is really important. So first, I actually communicated a long here at 1:30 because, and again, I'm looking at the 5-minute in conjunction with the 15-minute. The volume here is starting to pick up. This is a nice volume pickup for this time of day. 1:30 is usually still a lower volume, slower time of the day. So the volume begins to pick up, and even though the 5 minutes not extended to the downside, the 15-minute was, and the 15 is more important at this time of the day. So you get a little bit of a doji here with a little bit of a volume uptick. I'm like, all right, and we were early on the call. You could try some longs versus lows, keeping in mind that you're counter trend, that we're in an extremely bearish market, but there is a signal here for a counter trend trade. And I know some of you guys caught that. If you tried it in what was relatively weak, going back to relative strength and relative weakness, if you tried in what was relatively weak, if you tried buying the IWM, you just got basically stopped out right away. But if you tried buying relative strength, the Nasdaq was showing relative strength. Facebook, look at this Facebook bounce was showing relative strength. Rowan called out AMD to the team. AMD giving a nice bounce here. And AMD still above, and this is why I like the AMD call out, because it's still above its key $100 support level. So if you go after what was relatively strong, we kind of nailed that bottom there like pretty much perfectly for a good looking bounce, because again of our understanding of volume and market extension rules on multiple time frames. But it's a counter trend trade. And when you're counter trend, what's most likely going to happen, most likely the trend's going to continue and you're eventually going to get stopped out. So you go to your relative strength, and maybe this retracement became a bigger retracement. Maybe that bigger retracement comes reversal, or maybe it doesn't. And in this case, it really didn't. So then we set up here with this inside 15. This is a rest bar. This is a rest bar enables the extension to get satisfied. Because when a market is extended, there is two ways in which you can satisfy extension. You can satisfy extension through price or time. Basically, if you're extended to the downside of the market can bounce back up. That gives you a price correction, or it can extend through time, which means that it goes sideways and equilibrium catches up to it. That's what a bear flag is. All a bear flag is, or a bull flag, is a time correction of extension that's in the direction of trend. And what we started to see at this time of the day here was that this inside 15 created a bearish pennant. And in the NASDAQ, which was relatively strong, you also had this inside 15 now bouncing into its equilibrium zone, which is the lower band of which is that ADMA. And then it broke down. This was a shorting opportunity. This was an additional shorting opportunity for trend continuation to the downside. And we got this breakdown candle here at 215, notably low volume at 215. SPYs, breakdown candle is pennant. But we didn't break down, honestly, as hard as we should have, which is also notable, right? Going back to what I said about the market this morning, if the market should break down and it doesn't, that's notable. If the 15-minute chart here should be giving us a big breakdown and it doesn't, it's notable. So one other thing that we want to pay attention to is we pay attention to what I call candlestick negation, right? So you got this breakdown candle here at 215. If the market's ever to trade back above it, it negates it. So what I said at the time when I then had disconnection from the software here was that if we can get back above the high of this breakdown candle, that will probably end up ranging for the rest of the day or getting a bounce. What ended up happening? We ended up ranging the rest of the day, right? So, and that kind of summarizes the day to day as far as the market goes, and kind of how we're positioning ourselves in some of these initial trades. I should also talk about the Apple trade and the Bank of America trade, because I know that was some call outs at the open and some call outs in the morning meeting that kind of worked okay. But really what I want everyone to derive, if you're new to the team here, from this analysis is what we are seeking to do as professional traders in terms of understanding risk, reward, and probability of success, and understanding how all of these dynamic factors affect that situation, the risk, reward, and probability of success. Because at the end of the day, successful trading comes down to risk, reward, and probability of success. That is the formula of trading. I don't care if you're Warren Buffett. I don't care if you're a high-frequency trading robot or you're somewhere in between. It all comes down to risk, reward, and probability of success, and that's what we're constantly analyzing. We want to be humble enough to understand that there is no such thing as a 100% probability of success, that in a big enough time frame, every potential scenario will play out. And we want to assess how all of these different factors are affecting the probability of movement in any point in time, to have an understanding of supply and demand functionality and how it creates basically price movements. In other words, technical analysis, the true definition of technical analysis. So that is the market for today. I guess just a couple other trades to briefly talk about. Bank of America and the Apple trade. Bank of America long is probably like the trade of the day for a lot of people. Again, goes back to understanding of relative strength and relative weakness. In the morning meeting today, this was one of my ideas. I brought up, the XLF being up pre-market almost more than anything else. I meant to bring up, but I actually forgot because I was rushed, that Deutsche Bank was gapping up 9% again today. And I don't really care about DB. I don't like the bank. I don't hate the bank. It's not what I want to be involved in. It's an ADR. But what we have seen a lot recently is, especially with the Russia-Ukraine situation, is that Europe has really kind of been leading the U.S. in a lot of ways today. Great stuff, Popeye. I love to see it. So, DB gapping up huge was notable. And XLF was the biggest gap up I think I saw of any index, of any sector this morning. Look at this. Really big gap. Look at this. Relative strength. So we saw the relative strength early in XLF. Now normally, if I'm identifying a sector strength like this and I want to look at a sector, I kind of want to go to one, ideally now I find one that got upgraded by an analyst that day, and I'll make that my focus. I didn't see any of them get upgraded or downgraded in my personal research this morning. But I could see, typing up daily charts, very simply, right? So XLF, I know $37 is a really important level because that was a support level that was loose that the market broke down from. But now I'm typing up all these banks. Which looks strongest? Morgan Stanley, okay. Look at this recent price action. Bank of America, holding up better than Morgan Stanley. Goldman Sachs, ooh, much weaker here, right? Look at how far BAC has moved off of its lows. Look at how far Goldman's moved off its lows. So Goldman's weaker. Citigroup, at its lows, relatively weak. Wells Fargo, better, actually. I just am biased against Wells Fargo as a bank, so I don't really go there very much. JP Morgan, one of my favorite banks. Chart, not great, relatively weak. BAC, though, probably the best looking chart, the most relatively strong bank of the majors outside of arguably Wells Fargo. And this one also has a clear setup. It's into the equilibrium zone, so I don't love it as much. You know, going to counter trend on a sector here into the equilibrium zone is usually not what I want to do. But it's got relative strength. It's also got the inside day here on Friday, whereas most of them did not. You know, Morgan Stanley actually also had an inside day. JP Morgan did not, breaking lows of Thursday. Citi held Thursday's low, but was not an inside day. Bank of America, again, broadly, just the cleanest looking one. So if BAC can get above yesterday's high, well, there's a trade there. I mean, look, it's a very clear kind of daily resistance zone, and it's coupled with that inside day that we like to use for an execution strategy on the daily chart. And you couple, again, all of these factors, and look at that. Bank of America, absolute beast. Some of you guys were cheating, getting involved a little early, which I'd support that because you had the relative strength kind of confirmation. Some of you maybe waited for the break of yesterday's high, in which case your stop loss, honestly the ideal stop loss would have been the day low at that point, but you could have used a tighter stop loss as probably the low of that bar because it's a little bit of a pivot, especially once the ADMA catches up to that. Then it gives you a little bit of a bull flag type situation, or probably better to call this a bullish consolidation than a bull flag, but very small time frame, you could argue it's a bull flag. That breaks to the upside. Just great strength here. And then eventually also succumbs to the market weakness. Technical pullback here, depending on how tight you were trailing your stop, you might have gotten stopped out of your entire position into this bar. When this pivot low broke, that would be technically okay as far as I'm concerned. If you're a little bit looser, you might have been using this low here at 41.39 as your stop loss at that point, which also would have shaken you out by 3 cents. And I think one of you guys actually called out a relative strength long here off of this little base consolidation when it broke to the upside. And that was an okay little day trade too, but eventually that succumbed to the market also. And it just goes back to, you can look for your longs and relatively strong stocks and position yourself in the right manner. But if the market is just super relatively weak, if the market's just super weak like it was today, it doesn't matter how relatively strong your stock is, it's still going to end up kind of being a failure there. So Bank of America, no good at the close, but great intraday trade, and I think it was the best trade for a bunch of you guys today. The other one I wanted to talk about was Apple. So Apple should be bearing the brunt of the bad news in China today for a couple of reasons. One is that's where they make the phones. Two is that Apple has done a fantastic job making inroads as being an American company in China as far as a product that Chinese citizens want. My iPhone here that I have, I actually purchased when I was last in China myself. This should, in theory, be getting wrecked. And on top of that, it is the first time that Apple has traded below its 200 SMA in quite some time. Last time it did that, was back here. I guess it ticked below it in June 2021. And you also have this potential support from the low of February 24th, which was $152. So you're losing all that this morning. $152 is this last low. So the idea that I said and communicated as the market opened today was buying Apple back through 152. Because if it was going to be really, really bad, then the trade shouldn't trigger at all. It's opening below it. And if they are just money is pouring out of Apple, then it could be a gap and go to the downside despite the extension there. And it just won't trigger. So again, from a probability perspective, if you are buying bearish stocks if you're buying things that have been really weak, if you're buying things that have been going down a lot, buy them on the way up. Don't buy them on the way down. You know, you're just sticking out bids and you're trying to catch a falling knife, you got no idea where that thing is going to stop. But if you're able to buy things on the way up, at least you're trading in a very small time frame with bulls that are coming in, shorts that are getting squeezed, and you could get follow through to the upside on that, and you have a place that you can be long versus. You're not just putting bids out on the way down and, you know, hoping and praying that one of your bids happens to be somehow magically the absolute low, and then the thing goes up. You buy on the way up. So the idea was specifically because this low here to the penny was $152, and the stock was opening below 152, put an initial low at 150, 130, you could be long versus the opening low if it trades back through 152. And that was the trade. And it triggered in the first 5 minutes. It was coupled by an inside 5. The inside 5 broke up, and that's also when we started to see the relative strength that was coming out of the NASDAQ. Gave some follow through here to the 80 MA on the 5-minute chart. So now it is no longer extended on that 5-minute chart. That is when I communicated to the team, hey, anybody who's in Apple, great spot to book some profit, right? So again, we are communicating the entry point, the stop loss, where to book some profit. Now at this point, you book in profit here into the 80 MA. There's no possible way you should be able to lose money in this trade, especially if you follow my game planning rules. You got your risk covered. You sold a little bit more into the 80 MA. As a matter of fact, even if this becomes the absolute top and new lows come in right now for the day within 10 minutes, you should still make money in this trade if you have good game planning. And that is why game planning is such an important key to success in this business as well. And we're going to be talking about it via class tomorrow at noon. And then guess what? Higher low, higher high. NASDAQ showing relative strength. SPYs are showing relative strength. 11 a.m. SPYs are making highs. SPYs are clearing up. This thing's ticking above the 200 day. I'm like, man, if I can just get some confirmation from this NASDAQ, if this NASDAQ could just start holding above 326 here, this Apple could turn into a monster trade if this thing goes, you know, back to green just when everybody thinks it should go down, including myself. But it actually goes up, and I'm able to be long because of, you know, the technical setup. Because you got big extension here for Apple too. You know, and again, where could Apple trade to? If you bought 152 today, and Apple was able to close well, and the market didn't end up being weak, this Apple could easily bounce back to 158. This goes back to the concept I was talking about earlier. Finding small time frame risk for big time frame reward. If you're able to come in here and you're able to buy Apple for 70 cents risk, which isn't a small amount to be honest, especially for a small time frame, but it's not terrible. If you are able to come in and buy Apple for 70 cents risk here, and then you happen to get a good close, and you happen to swing it, and then by tomorrow, especially with the way the volatility has been, by tomorrow the stock's at 158. You just made $6 on 70 cents worth of risk. It's a pretty good risk reward, and you're still in the position for further upside follow through. The big picture first target would only be 158. Your big picture second target would be 162, and then 170 becomes a huge level. And this is how, even though it's low probability, you don't need low probability to work in your favor too often. This is how, on the occasion that your 70 cents risk in Apple, sometimes it's even less, hits your first target, and then because of gamma being negative and volatility being so high, it hits your second target, 162, and then it makes a higher low and you're trailing on a daily chart, and that actually creates a reversal, and next thing you know it's at 170. And then next thing you know, because it's Apple and it's one of the greatest companies that there's ever been, and it's got this massive buyout, and they've got all this cash on hand, next thing you know, the thing's back to all-time highs. This is how, in a low probability scenario, and you don't need it to happen too often, you get what I describe as overwhelming risk reward. What's the type of risk reward ratio that I'm looking for? Honestly, the type of risk reward ratio that I'm looking for is infinite. And that sounds ridiculous, and it probably is, because it's not going to be possible. But if you have that type of thought process, that is how you can occasionally, and it only needs to be occasionally, to make big money, occasionally get these massive 100x risk-reward trades on your side. So that kind of covers the Apple trade. We covered the market. We covered relative strength and weakness. We talked about technical equilibrium. There were some other okay trades today. We had that, that VIX short trade to the downside. One of you guys called out the Apache bottom perfectly intraday, which was awesome also. So there's some other good stuff out there too, but it's already almost 5 o'clock. This is usually when my afternoon meeting ends, and we didn't even start the Q&A. So I'm going to end my portion of it here. And I'm going to turn it over to you guys to answer any questions that you have. So the way that I do this is I go back into the VTF here and I scroll up usually to about 10 after 4, which is where the afternoon meeting begins. And then I just kind of scroll my way down, reading what people say here and answering questions kind of as I see them happen. Okay. See you guys talking about Omicron and Delta in China. There's a newly dubbed variant detected in Europe. Jeez, man. Interesting. I'm at 4:32 and still haven't seen any questions yet. Sebastian wanted me to explain the BAC trade and how it could have been executed. I think I covered that, Sebastian. If you have any follow-up questions on that, just add those questions in here in the bottom of the VTF, and I'll get back to it. But I think I went over that one in detail already. First question I'm seeing here is from T Money. T Money, how much more risk are you using for A+ trades? Great question. And how are you increasing your max days limit down amount on a day like February 24th. Okay, cool, great question. So, and I think Team Money's aware of this because I think he's been on the team for a bit now. So I teach traders to implement something that's called risk skew. All right, risk skew basically means that you want to risk more on better trades and risk less on trades that aren't as good. Obviously, you wouldn't take the trade at all if it's a terrible trade that shouldn't work because every piece of probability is against it. So these are all going to be specifically for trades that you think can make you money in the long run. But one thing that I like to teach traders to do is to grade their trades, a letter grade, like back with what we got in school, where there is an A+ for a fantastic trade where it's an amazing risk reward and every single layer of probability is on the side of that trade. And you can work your way down to maybe a C type trade, which is one where you don't have every layer of probability on your side, but you still think you'd be able to make money in the long run. The risk reward is there. It's worth a shot with a little bit of risk type of situation. Anything worse than a C trade would probably be something that you wouldn't take. So I teach traders to do that because it's a great way to start to learn your probability factors. Because we have, and again, you can find this in my training program class, and the way you can get to my training program is by talking to the great folks here at T3 Live, or also I'm actually probably going to be talking about this a little bit on my Thursday lesson. We have these different layers of probability that are ubiquitous for the market that are basically factors. So, if you've got a trade here that's got a good potential risk reward, and it's got 8 out of 8 layers of probability on the side of the trade, then you could be looking at an A+ trade. Whereas if you've got an okay risk reward and 5 out of 8 layers of probability on the side of your trade, then maybe you're looking at like a B- type of situation. So you should build a system for yourself, because to step all the way back, the key to consistent profitability in the marketplace is to do things consistently in regards to the marketplace. And the only way to do things consistently in regards to the marketplace is to have rules that can enable you to do that. So this goes back to strategy, game planning, and having a rules-based approach for the market. So this then comes down to T-Money's question here about risk skew, which is how much more are you risking in an A+ trade versus other types of trades. That's going to be heavily dependent upon you, your experience level, and your account size. But so I like to think about it in terms of basic numbers. An A+ trade, here's the best way to think about it. We talked earlier when I was doing a Q&A prior to the afternoon meeting starting at like 3 o'clock today, about money management and risk management rules. We talked about giving yourself a limit down. Your limit down is the maximum that you will allow yourself to lose in any given day. I think an A-plus trade is a trade that you risk your entire day on. And it should be a trade that happens very rarely. It might only be once a month, something like that. But that trade is so overwhelmingly in your favor that you say, I'm risking my entire day on this trade. So if your maximum limit down is losing that $500 that we talked about, you're going to risk $500 on that A-plus trade. And then you can break down your system all the way down to that C trade. So that A-plus trade is $500, and an A-plus trade is an A trade is $400, and a minus trade is $350. Again, kind of just working your way down a scale for yourself. So that would, I think, be your starting point, is how much you're willing to risk on a day. Thanks for the question there, Team Money. Hope is asking if the session, is it recorded? Yeah, so follow, I'm just going to give myself a shameless little advertisement here. Guys, YouTube search Derrick the Trader, press the subscribe button. This is a newer thing that I just started. I've been getting a lot of little lessons in here that you guys might want to check out. So give it a subscribe. You're helping me out, and you'll also be able to learn. And this afternoon meeting will be in the Derrick the Trader YouTube when it's done, so that people can re-review it. Never put my morning meetings in here. So if you really want the trade ideas ahead of time, you got to be a member of the virtual trading floor. But if you want just some access to some learning, access to some of these afternoon meeting lessons that we're doing and some other small lessons I put in, give the Derrick the Trader YouTube a subscribe. From Arnie, when COVID-19 flares, how does that affect health stocks? So, I mean, the main thing that I paid attention to is how that affects the vaccine companies, Moderna, Pfizer. I don't trade a ton of individual biotech stocks. I actually really don't like, it's almost a rule for me. I really don't trade individual biotech stocks. I'm just not an expert in the field. It's always the biotech stock that gaps up 400% or gaps down 90%. And as much as I would love, and it's never happened to me, to wake up one morning and see one of my stocks up 400%, I'm not willing to risk my career on a leveraged position gapping down 90%. So I have a general rule where I really avoid kind of biotech stocks. That is not my area of expertise, and I just think that there's just too much risk there, which makes it just not worth it to me in the long run. I will trade the ETFs, so like the XBI or the Labu ETF. I will trade that. And obviously, during the COVID situation, the move that like a Moderna had, something like that, is obviously notable. And even Moderna, honestly, I can't remember the symbol all of a sudden. mRNA, right? mRNA. Even like a Moderna, I've actually always been very hesitant to trade this stock, though I do trade it sometimes. And this had a sick move today. For a while, whenever we were seeing a new variant come out or something like that, that Moderna was catching a huge bid. We kind of stopped seeing that recently because it seemed like with Omicron, like, COVID was going away. I know it's not fully going away, but, it kind of has felt like that here in America at least. And then today, this caught a huge bid. And once again, this is why teamwork and having access to the virtual trading floor is so important. When you guys called this Moderna out when it was at $149 today, and it ripped to $166 on that momentum move, I don't know if it was a good risk reward to buy at $149, but it was certainly notable with how the volume was coming in. So maybe there's some speculation. My understanding is that the vaccine that China has been using has been far inferior as far as effectiveness goes than the Moderna and Pfizer vaccines. So maybe there's some speculation that with this latest flare up in China, that they might start importing it or something like that. We'll see. Otherwise, I really don't know. But Moderna caught a huge bid this morning. Next from PJ. So do you put in trades early morning according to your plan, or do you place manual orders? Both. I do both. It depends on the specifics of the trade, the specifics of the situation. If it's a swing trade where I have a specific game plan that's already in place, I will sometimes even at 5 o'clock in the morning be liquidating, or usually liquidating. I get very cautious to add, or especially add heavily, too much before 7 a.m. Eastern time, just because there's not a lot of liquidity in case something bad were to happen. But especially, if I have a game plan that says I'm supposed to take profit somewhere and the market's gapping up into or even above where I'm supposed to take profit, I'll do that at, the second I wake up, the second I roll out of bed. So I do that according to my plan. And all the orders I'm placing into the market are manually. I don't trade robotically. The T3 trading group, for people who have algorithmic interest, T3 trading group has a really robust algorithmic division. Roby wants some BABA levels. Robbie, I'm not sure which it is. Yeah, there are no BABA levels. BABA is below its IPO. I can't believe it. 60, right? Wasn't 60 a huge level? It's funny. I remember the importance of 85 in 2015 and 2016. $85 was the biggest resistance level of almost any stock that I had ever seen up until that point. And then when it finally broke out, this was one of the best trades I had in my career up until this point. How do I zoom in again? When BABA finally broke out through 85 on this day right here, August 10th, 2016, I caught that as turned into like the best trade I had in my career, I think, up until that point. This massive breakout happened. It was followed by a huge gap up. I don't remember specifically what caused that. And then it just had this sick trend up all the way to $120. It was just a huge move, and I caught it on size. I remember that very specifically. So any levels that you're looking at in Alibaba right now, if you want to talk technical levels, you got to go back to 2016. Stock broke 80 today. It's below the 85 breakout level that I had bought. So 80 was a bit of a level. You have some support at 73, and then you got support at the all-time low at $60. $60. Incredible. I'm in the Charlie Munger camp on Alibaba. So I'll let you research what he's been thinking, what he's been saying on Alibaba. I'm in the Charlie Munger camp on Alibaba. Really like the company. Really want to be long, but don't catch a falling knife. We gotta wait for a signal. Justin uses a technical indicator called balance of power. It's proprietary to TC2000. Okay, cool. I never heard of it. Is there anything like that on Lightspeed? I have no idea. Balance of power judges if power is in control of sellers or buyers, I think is what you're saying here. Not that I am really aware of, Justin. I've never seen the tool. I've never even heard of the tool up until now. My view on technical indicators is I'm always interested. I'm always interested in the information that they're providing. Even though my charts are very simple. I use technical Chinese candlesticks, volume, and a couple moving averages that are important to me. That's all I use. But it doesn't mean that I'm against other indicators or oscillators or whatever, and I pay attention to all the information that's provided to me. For example, Pat here on the team, who's a phenomenal trader and publishes his morning note every day, you will see when you read the technical part of his morning note that he publishes that he uses different moving averages that I do. He uses Bollinger Bands. He uses Ichimoto clouds. I don't use any of those things, but it doesn't mean I don't pay attention to the technical information when he provides it. So, for me personally, I don't see a need for my own trading in using the indicator that you're describing. But if you're a part of the team and you provided the information to the team, like everyone else does, it would be appreciated, noted, and I would, pay attention to it as an additional piece of information for the market and for my own trading. Thanks, Olivia. Thanks for the shout out, Gabriel. How would you have traded your VIXI if you would even trade it? And then that VXX would be, if we spoke about VXX, it would turn into another hour on this afternoon meeting. Yeah, so UVixie. So I don't like being long UVixie or VXX. Let me start by saying that. I would rather be short the market than long these products, and that's because these products are trash. They are trash. They are subject to time decay, or at least VXX was until today. Um, they are subject to time decay, which means that they will inherently only go down in the long run. If the market goes sideways, VXX and UVixie are going to go down. If the market goes up, VXX and UVixie are going to go down. The only time these things actually go up is if the market's really selling off hard. And then these things can go up very fast in a small period of time. So the only time I ever would trade a VXX or UVixie to the long side is if I am already pre-planning it to be a very small time frame trade. A day trade, or at max a 1 to 2 day swing. Otherwise, because of the time decay, I would just rather be long. I'd rather be short the indices than long these products. But they can pay you a lot of money if you capture them right. Then he remembers the TVIX, which is now defunct. That was another garbage VIX product that was super leveraged and had the same time decay. That was my best trade in the coronavirus crisis was TVIX long. Went up like 10,000% or something completely insane. So I actually really like to be short. Like if I think the market's going up, I love shorting VXX because of the time decay. It gives me an extra bang for my buck. I love shorting this VXX, and VXX also tends to be easy to borrow, at least for the professional accounts at T3. UVixie is always hard to borrow, so you got to pay for the borrow. So that's the general answer to your question, RA. The smaller time frame answer to your question, I wasn't really looking at this, to be honest with you, to the long side for a trade today. You can definitely see kind of the stair-stepping higher here, kind of like a series of time and price corrections. You could have potentially looked for continuation execution on it. For me, this is more information. It's more information than a trading vehicle. Thank you, Andy. Got Andy here providing the Twitter link. Gabriel mentioning that Derrick the Trader is on TikTok as well. I haven't posted on TikTok in a little bit, but I'm probably going to pick that back up again soon. And Twitter, I gotta remember to start using that more. It's important. From V, could you please comment on how much of an impact the wash sale rule has on your trading, if any? This is a great question, because you give me the opportunity to talk about one of the many benefits of being a professional proprietary trader. The wash sale rule does not apply to professional proprietary trading. So if you are a serious trader and you trade with high frequency, you should reach out to T3 Trading Group about potentially being, applying for a professional proprietary trading position. There are a lot of benefits. You get significant increase in capital access. You get a K1 at the end of the year instead of a 1099 at the end of the year. I am not an accountant. Don't take tax advice from me, but I believe that an accountant would tell you that a K1 is going to be much more beneficial to you as a trader who trades in and out a lot than a 1099. And you don't have to worry about the wash sale rule. So it has zero effect on me. I don't have to think about it. But I have spoken to plenty of traders who are in retail accounts and did well for themselves and think everything's going great, and then all of a sudden the tax man cometh because of the wash sale rule, and they can't write off certain losses and stuff like that. I honestly don't even know too much about it because it doesn't affect me, but that is a problem. From Hope here, any particular broker that you feel are quite good for your kind of trading? Yeah, T3 Trading Group. T3 Trading Group has retail accounts and professional accounts. I was just talking to V here about the professional side of the business. We also have retail accounts. But make no mistake about it, the retail accounts at T3 Trading Group are specifically for traders who trade, because they're not free. There's costs involved. There's like a monthly platform cost. There's a commission cost because you have direct market access. But there are significant benefits to, if you trade with frequency, I think you're better off being with an account that you have to pay a commission to for direct market access, as opposed to being with a free account that is selling all your orders to HFT firms and potentially giving you, much worse execution on the trades. Now, if you don't trade a lot and you do want a free account, I hear good things about Thinkorswim's platform. You could look into that. Maybe Schwab is okay too. But I really would recommend, for anyone who is trying to do this seriously, you want to have a direct market access account. So you could have an account with Interactive Brokers Pro, where you pay a commission. You could have an account with Lightspeed, which is Line Brokerage. T3 Trading Group has a partnership with Line Brokerage, so if that interests you, then please also reach out to T3 Trading Group on that, because it'll benefit the company. Or just have an account with T3 Trading Group. They use Stone Trader Pro as their retail software. You guys can email me about this stuff if you want, and I can provide information or send you into the right place. My email address is doldensmith@t3trading.com. First initial, last name at t3trading.com. From Robbie, so Baba concerned about potentially being removed from the American markets. Yeah, I know. I definitely have heard that, and there are also definitely concerns about the way the ADR setup kind of is for those things, with how they're based. Assuming nothing wacky happens with that, it's a company I'd love to be long. And I would assume that if it gets removed from American markets, that you still get the value of the stock given to you in cash or something as it's being removed. Otherwise, there'd be a real issue. I don't see all of a sudden tomorrow Alibaba getting taken off the exchange, and if you own Alibaba at $80 a share or whatever at 77, 78 where it closed today, that you're not seeing your $78. From Justin, is there any value in using Heikin Ashi candles for trend indicator on 3 minutes? I have no idea what that is, Justin. That is a new one for me. Where's Pat? Pat's the guy who seems to know everything about everything when it comes to every type of indicator that ever existed. I have never even heard about the Heineken Ashi indicator before, or candles, but I would like to drink one, especially after my voice is starting to go from all the talking I've been doing today. And I don't use 3-minute charts. The smallest I use is a 5-minute. Awesome stuff, RA. Good stuff. Peloton initiated with an outperform at Bernstein, $40 price target. Moving on that at all? A little bit maybe. We can keep an eye on that on the radar for tomorrow. This Peloton was trying to be relatively strong early today too. This was one of the best looking ones here pre-market, nice and green. Not pre-market, early on, and then it really rolled over. From YouTube on Payne, short idea today at 12:10. What do you think? Oh, PHM. PHM short idea today at 12:10. Yeah, I mean, you're breaking your intraday support here at 44.40. Let's look at the daily chart though. Daily chart's below all support. The only problem with this is it's starting to become kind of extended to the downside in this thing at that time of the day. So I would actually kind of view that as a layer of probability against the trade, was the degree of downside extension on the daily chart by that point. But if you're looking at the 5-minute, beautiful ascending triangle, which is a bearish pattern into intraday support as a breakdown. So you could definitely be short that, versus the last pivot high, or maybe actually versus this pivot high. You could have been shorting versus 44.70 on this break of new lows here. Not bad at all. Steve C. saying he spoke to his CPA last week, and with the wash sell rule, if you file your taxes as a day trader, taxes your taxes income. From Cedric, how does the risk management system work with T3 Trading Group in regards to options traders? Not a short answer to this question. I'll try to give you the short answer. So it's going to be the same thing for an option trader or an equity trader, really. The only thing that T3 Trading Group does not allow for, it's literally the only strategy that we do not allow for, is the naked selling of options from a risk perspective. So that just won't happen. You won't be able to get naked, you won't be able to do any naked call selling. It's just not going to happen. But you'll have what I described earlier as a system lockout, which basically puts you into closing orders only. So that number should be greater than your personal limit down number that we discussed. But if you trigger your system lockout as a professional trader with T3, it's not an auto liquidate functionality. It doesn't liquidate your positions, so you still have to manage your open risk. But it will not allow you to add new positions or to add size to any current positions. And then T3 has a whole risk management department at the company with proprietary risk management systems where we are keeping track of the firm's total risk and positions outstanding and P&L and kind of things of that nature. One more point here, as a general rule, what T3 Trading Group is trying to do with its traders is to not necessarily have hard, fast rules with traders, but to have a relationship. We just want everybody to be on the same page. We want constant communication to occur between the trader, the trader's manager, and the risk management team at the company. From Alex, when you do market election, you have 2 years look back. I apologize, I don't understand the comment or question. From Justin, if I get an account with T3 Trading Group and I have only 5,000, yeah, so retail accounts with T3 Trading Group, retail accounts, are all required to be above the PDT rule. Professional accounts, you don't have to worry about PDT. PDT is not a thing for a professional trading account, just like wash sales. From Ross here. Read something about Barclays limiting shares of a certain VIX product. Have you heard about this? Ross, we were talking about it all day today. VXX. Yeah, the VXX today. I think that had to do with this. Honestly, this is so interesting, and I don't want to get into it too much because it's already 5:30. This actually could have further led, and it probably did, to the overall market weakness today. This VXX information is super, super interesting. If the VXX is not doing the redemption initiation process anymore, it gets rid of the time decay. There are entire funds, there are entire algorithms that are specifically designed to short VXX versus off of time decay. And if all of a sudden they're not doing the thing which creates time decay anymore, and you're running a fund or an algorithm that is designed to make money short off of that time decay, what do? You kind of have to liquidate. So that really could have led to this VXX moving higher, and it even could have led to the market itself moving lower today. So really, really interesting stuff. No, RA. The question was, does T3 sell its order flow? No, we do not. So if you're a professional trader or you have a retail account in T3, you are provided with direct market access, direct market routing at a commission cost. We are not selling the orders out to HFT firms. And that, I think, is where the advantage comes from of this type of account if you are an active trader. All right. It looks like I got through everybody's questions in the VTF. It is 5:30. I'm starting to lose my voice. We managed the day really well today as a team, despite it being not the easiest or the greatest day in the world. Let's see how we gap tomorrow morning. We'll come up with our game plan like we always do. Again, we get the research here in the VTF usually starting around 7:30 or so in the morning. So, for people who, have the advantage of being here for this week, come in earlier. I would say don't wait till 9 o'clock. Come in at 7:38. Pay attention to the same information and the same research that I'm utilizing myself as I formulate my game plan as we go into our morning meeting, which will take place at 9 a.m. tomorrow. Once again, give the Derrick the Trader YouTube a subscribe. Reach out to your favorite T3 Live individual for more information on how you can join the ProDesk virtual trading floor. And if anyone is interested in any of those T3 type accounts that we discussed today, You can email info@t3trading.com, or you can email me personally at doldensmith@t3tradinggroup.com. Have a great night, everybody. I will see you all tomorrow. You're welcome.